Welcome back to the channel, finance enthusiasts. In today's video, we're shifting our focus from tech to consumer defensive stocks. We'll be diving deep into some of the most well-known names in the packaged food industry: General Mills, Hormel Foods, Kraft Heinz, and McCormick Company. These companies have been staples in our pantries for years, but how do they perform financially? Is now the right time to invest in these household names? Let's break down the numbers and uncover the strengths, weaknesses, and future potential of these food giants. The P/E ratio is one of the most widely used metrics to assess a company's valuation, telling us how much investors are willing to pay for each dollar of earnings. It's a great starting point to compare these four companies. Currently, General Mills has a trailing P/E ratio of 15.54, which is below its 5-year average of 16.82. With a forward P/E of 14.86, it suggests that the market is somewhat cautious about future growth. However, this conservative valuation could indicate an opportunity for value investors. Hormel Foods' P/E ratio is 20.37, slightly lower than its 5-year average of 25.26. The forward P/E drops to 19.09, suggesting that investors still have confidence in Hormel's future profitability, but at a more tempered pace. Given its history of stability, this stock remains a solid choice for those seeking defensive investments. Continuing, Kraft Heinz has the lowest P/E ratio of the group, standing at 12.12. It's only slightly lower than its 5-year average of 12.32, and its forward P/E drops further to 11.39. This low valuation reflects the market's cautious outlook on the company's ability to generate future earnings. However, for those looking for a bargain, this could be an interesting pick if you believe in the company's long-term turnaround potential. McCormick, the spice giant, has the highest P/E ratio at 26.73, almost matching its 5-year average of 26.70. The forward P/E of 25.65 indicates that the market expects McCormick to continue its steady performance, but there may be limited upside in terms of valuation growth. In terms of valuation, Kraft Heinz is the most attractively priced, while McCormick may seem overvalued, especially in a market where growth is slowing. Now let's adjust the P/E ratio for growth using the price-to-earnings to growth ratio. A P/G ratio below 1 generally indicates that a stock is undervalued relative to its growth potential. General Mills has a P/G ratio of 5.23, which suggests the stock may be overvalued relative to its growth. Hormel's P/G ratio is more reasonable at 3.63, but it's still on the higher side, signaling that investors are paying a premium for expected growth, which could be a concern if growth doesn't meet expectations. Kraft Heinz comes in with a P/G ratio of 4.56, reflecting similar concerns. Despite the low P/E, its expected growth doesn't seem to justify the price. Investors might want to proceed with caution unless there's a clear catalyst for a turnaround. McCormick has a P/G ratio of 3.82, which, while high, is more aligned with its premium valuation and the brand strength it enjoys. However, investors should weigh if this growth justifies paying a premium. Insider ownership can tell us a lot about how much faith the company's leadership has in its future. Hormel Foods shines with an impressive insider ownership of 47.01%. This is a strong indicator that the company's executives are heavily invested in its success. This is a great sign for potential investors, as high insider ownership aligns management's interests with shareholders. McCormick also stands out with 6.19% insider ownership, which is significant for a large-cap company. It shows that the leadership team is committed to the long-term success of the business. General Mills and Kraft Heinz have insider ownership of 0.4% and 0.39%, respectively. While these percentages are low, they reflect the larger structure of these corporations, where institutional investors hold the majority of shares. Profitability is key to understanding how efficiently a company uses its assets and equity to generate profits. Starting with General Mills, with a return on equity of 24.6% and a return on assets of 7.62%, General Mills shows it's effectively using shareholders' investments to generate profits. Its return on invested capital of 15.24% is also impressive, indicating solid capital efficiency. Hormel's return on equity of 10.02% and return on assets of 5.88% are more modest but still respectable, considering the company's consistent dividend growth. Hormel's return on invested capital of 10.11% signals that the company is managing its invested capital efficiently. Kraft Heinz lags behind with a return on equity of 3.89% and a return on assets of 2.14%, reflecting its struggles to generate significant returns. However, it does have a return on invested capital of 7.16%, which suggests that there's still some value being generated from its capital investments. McCormick's profitability is strong with a return on equity of 15.14% and return on assets of 6.05%, and a return on equity of 10.14%. These figures indicate that McCormick is highly efficient in generating returns from both its equity and assets. A company's share count can greatly impact shareholder value. General Mills, Hormel Foods, and McCormick's have all been maintaining their share counts over the last decade. Kraft Heinz, however, has increased its shares count till 2017 and since then a slight decrease in share count, signaling a different capital allocation strategy. Now, earnings per share or EPS is a key metric that tells us how much profit a company is making on a per-share basis. General Mills leads with an EPS of $4.50, reflecting its strong profitability and ability to generate solid earnings from its operations. McCormick follows with an EPS of $3. But looking forward, McCormick is projected to have the highest EPS growth rate over the next 5 years, at 7%. And the worst performing one will be Kraft Heinz with a projected annual growth rate of 2.66% during the next 5 years. Historically, again General Mills and McCormick have seen good EPS growth over the past decade, with a compound annual growth rate of 6.58% and 5.17%, respectively. While the other two companies had a more modest trajectory. Free cash flow per share gives us an idea of how much cash a company generates after accounting for capital expenditures, which can be used for dividends, buybacks, or reinvestment. McCormick has a 8.09% free cash flow per share growth over the last decade, while General Mills boasts a modest 5.44% free cash flow growth. Unfortunately, Kraft Heinz has a negative free cash flow per share growth, most of all due to its shares' outstanding increases. Let's talk about dividends, which is an important factor for many defensive stock investors. General Mills offers a solid dividend yield of 3.43%, with quarterly payments of 60 cents. Over the last decade, its dividend has grown at a rate of 3.26% compound annual growth rate. Not the fastest growth, but steady and reliable. Hormel Foods, in contrast, with a yield of 3.51% and impressive dividend growth of 10.65% compound annual growth rate over the last decade. This makes Hormel an attractive option for income-seeking investors. But be cautious because if we look at growth only recent years, we can see a deceleration. Despite some struggles, Kraft Heinz offers the highest yield at 4.44%. However, its dividend growth has been negative, at -2.91% compound annual growth rate over the last decade. It keeps stable since the last decade, but now if we don't look to its debt, it seems to be an opportunity to increase with free cash flow payout ratio near 60%. Finally, McCormick offers a more modest dividend yield of 2.24%, but it has seen solid growth of 7.75% compound annual growth rate over the last decade. This shows McCormick's ability to return value to shareholders consistently. Continuing with margin ratios, operating margin and profit margin that are key indicators of a company's efficiency and profitability. Kraft Heinz takes the lead here with an operating margin of 20.58%, demonstrating strong operational efficiency. General Mills follows with an operating margin of 17.48%, and McCormick comes in at 16.05%. Hormel Foods lags behind with an operating margin of 8.92%. In terms of profit margin, General Mills in this case stands out with a whopping 12.14%, followed by McCormick at 11.87%. Kraft Heinz and Hormel Foods posted more modest margins with values of 7.3% and 6.52%, respectively. When we look at the evolution of revenue and earnings over the last 8 years, only General Mills and McCormick show positive growth, but there are some key differences. Because McCormick lagged behind Consumer Staples ETF, XLP, while General Mills obtained a very similar total return during the last 5 years. On the other hand, are Kraft Heinz and Hormel Foods with flat evolution of earnings and revenue. In this case, Kraft Heinz showed an impressive total return during the last 5 years, outperforming the XLP. Debt levels are crucial for understanding a company's financial health, especially in a rising interest rate environment. General Mills has a debt/EBITDA ratio of 3.34 and a debt/FCF ratio of 4.80, which are manageable but something to monitor if cash flows decrease. Hormel Foods is in a better position with a debt/EBITDA ratio of 2.47 and a debt/FCF ratio of 3.67, indicating a healthier balance sheet and more flexibility. Kraft Heinz debt is a concern here, with a high debt/EBITDA ratio of 4.27 and a debt/FCF ratio of 6.55, reflecting the company's challenges with leverage. Finally, McCormick has a debt/EBITDA ratio of 3.51 and a debt/FCF ratio of 5.93, showing that while manageable, its debt levels are something to keep an eye on. Now, let's check the stock performance and market cap over the last year. General Mills has posted a 10.65% return, with a market cap of $38.82 billion. Despite being a solid company, Hormel Foods has only seen a 1.04% return in the last year. It has a market cap of $17.65 billion. Kraft Heinz has outperformed with a 13.46% return and a market cap of $43.53 billion. McCormick leads the group with a 30.99% return over the past year, giving it a market cap of $21.52 billion. Now, let's talk about the crystal ball moment, analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. General Mills has a price target of $74.76, representing an upside of 6.91% from its current price of $69.93. My fair value estimates tell a similar story. For me, General Mills is close to its fair value at $68.64, suggesting it is fair valued right now. Continuing with Hormel Foods' price target is $32.38, which actually represents an upside of 0.59% from its current price of $32.19, indicating that analysts see the stock as potentially fair valued. And for me, Hormel Foods, with a fair value of $28.93, appears currently overvalued. Now, Kraft Heinz has a price target of $40.15, with an upside of 11.53% from the current $36. And for me, with a fair value of $36.22 can indicate a great opportunity to start adding this company. Finally, McCormick's price target is $84.22, representing an upside of 5.04% from its current $80.18, with a fair value for me of $66.62, which is far from the current price and can indicate an overvaluation too. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. So, there you have it. General Mills, Hormel Foods, Kraft Heinz, and McCormick all have their own strengths and weaknesses. Whether you're looking for strong dividend payers, profitability, or growth potential, each company offers something unique. As always, it's essential to align these metrics with your own investment strategy. If you enjoyed this breakdown, don't forget to hit that like button, subscribe, and ring the bell for more in-depth financial analysis. Until next time, happy investing.